Okay, I wanted to create a quick video. Uh, we covered this in class, but it's just an important concept in accrual accounting that I felt was worthy of covering again. Uh, this is talking about the matching principle. See if I can write it right quick. You have to forgive me. Sometimes this is slow. And the matching principle, what it basically says, and it's one of the principles in accounting where we're trying to accrue revenues and expenses so that they match. That's the whole idea behind matching. We're trying to match revenue and expenses together. So let's take, for example, Kinko's. And let's assume that on 1/1 of, I don't know, pick a year, let's say they buy $5,000 worth of paper. Okay? So they buy it on account. When you buy it on account, ask yourself, which way is the money going? Is it going away from you or is it coming towards you? So we're going to buy this on account. I'll give you a minute to think about it. Okay, if we're buying on account, cash uh, normally would go away from us, like cash would go away from us and we'd buy. The problem is that we're buying on account. And if money is going away from you with the transaction and it's on account, that means it's accounts payable. So let's go ahead and do our accounting entry. 5K and 5K. And we're buying, let's say we're buying paper supplies. Paper supplies. This is paper supplies inventory. We're not crediting cash, we're crediting accounts payable because we're going to owe this. That's what on account means. If you think about it, or if it makes you more comfortable, it's on account of we don't have the cash to pay it right now. And let's assume that in March, let's say March 15th, just for fun and profit, let's say that March 15th, we actually have a job that uses all the paper. So we're going to use all the paper. And when we use all the paper, let's say that we have revenues of 10,000. Okay, so some kind of paper revenue of 10K. And let's assume we sold this. Let's say we sold this $10,000 job. We're Kinko's, and we sold it on account. Again, the magic on account. You have to ask yourself, again, which way is the money going? If we're selling on account, where will the cash leave us or come towards us? I'll give you a minute to think about it. Okay, if you sold, cash will eventually be coming in. You would normally book cash here, like debit cash because it's an asset and it's going up. The problem is on account means you're getting an accounts receivable. Now I want you to notice something. Let's assume that this accounts payable is due in May, just to pick a month. So we get to May, and let's pay this, because now it's due. This payable to others is due. So we're going to debit the accounts payable for 5K, and now let's go ahead and actually pay it. Something's got to go down, and it's cash that goes down. So this is when it's paid. And let's assume that this accounts receivable, right? Let's assume we collect this in July. So here we are in July. When we collect cash, cash goes up, so it's a debit. Cash is an asset. Assets go up with debits, go down with credits. And of course, if we're collecting this receivable, that means we take the receivables off the books. So here's our credit to accounts receivable. You will carefully note that this is canceled out by this, so we no longer owe it. And this is canceled out by this, so we no longer are going to collect it. The question is, when should this, what month should this be recognized? Well, this expense for this. Notice we're not booking an expense, we're booking paper supplies. And the question is, when should this be recognized? Well, the thing you can always eliminate is when you actually pay has no bearing on when you recognize this expense. And you notice when you collect for this job, so when you pay cash and when you collect cash, has no bearing on when you recognize this expense. This expense in this example here is expensed inside of March. So you would expense this paper. Notice we have no paper expense. This is paper supplies inventory, and there's no expense. This has not been recognized as any kind of expense. The question is, when is it recognized? Well, it's recognized to match the revenue that it generated, because all of this $5,000 worth of paper was used on this job that gave us $10,000. So let's make our entry. See if I can write. Oops, that's too far over. Well, we'll make it work. Paper expense, we're going to have a debit of $5,000, and then we're going to have a credit of paper supplies. And here's your credit for $5,000. Sorry, it's very messy. But this month is when you recognize paper expense. You do not recognize paper expense when the paper is paid for, and you do not recognize that paper supplies expense when you collect cash. You match, right? You match the revenue to the actual expense and make your expense entry. That's what the basis of the matching principle is. Matching expenses to the revenue in which they basically are coordinated and created that revenue. I hope you found this useful.